So hello everybody, welcome to the final week of our tutorials, week 12, and I'm going to discuss the money part of the tutorials in the week 12. So as usually in this video, we are going to discuss all the questions that are in your tutorial questions posted on Blackboards, but we will discuss them in more details in the classes. So the first question is, which of the following is not a function of money? So we have four answers to choose from. First one is medium of exchange, store of value, measure of functionality, and unit of account. So the only thing that is not function of money is the measure of functionality, which means that answer C is the correct answer. Question number 2, which of the following is not true about the Bank of England? And here the correct answer is answer B. The Bank of England is the UK's largest high street bank. A Bank of England is obviously not a high street bank. Question number 3, what is the interest rate? The correct answer here is answer A. The interest rate is the cost of borrowing money. Question number 4, the demand for money does not include, and we have four answers that are offered to us. So we have the transaction motive, the precautionary motive, the contractionary motive, and the speculative motive. And the correct answer is answer C, the contractionary motive, as you discussed already in your lectures. Question number 5 states the lower interest rates are likely to lead to. And the correct answer here is answer D, a fall in the exchange rate. Sixth question states the interest rate in the UK is set by and we are supposed to fill in the blank. The correct answer here is Monetary Policy Committee. Question number 7 requires us to do some of the calculations. So it states, imagine that the banking system receives additional deposits of 100 million and that all individual banks wish to retain their current liquidity ratio of 20 billions. So how much will banks choose to lend out initially? Their additional deposit of 100 million, and we are told that all the banks would like to retain 20% as the reserves. So 20% out of 100 million pounds is equal to 20 million pounds. So everything that banks do not retain as reserves, which in this case is 20 million, they're going to lend. The answer to this question is 100 million minus 20 million, and the answer is finally 18 million. So banks will choose to lend out initially 18 million pounds. Question B is, what will happen to banks' liabilities when the money that is lent out is spent and recipients of it deposit it in their bank accounts? So the correct answer here is that it will increase by further 80 million pounds, and we will discuss this question further in our tutorial classes. And finally, question number C is asks us how much of these latest deposits will be lent out by the banks. The latest deposits from the question B are 80 millions. So what we need to look at is from the question A, the percentage or the ratio of the deposits that banks are lending and the rate of those that they are keeping as reserves. So banks are keeping 1/5, so 20% as reserves, and they're lending the remainder of money. So 20% out of 80 million is equal to 16 million. So this will be kept as reserves, and everything that is not kept as reserves will be lent. So it's 80 minus 16, which is 64 million. So that is the answer to question number 7. Question number 8 states a decrease in reserve requirements, and then we are supposed to fill the blanks with increases or decreases. The money multiplier, then again we are supposed to fill in the blanks, the money supply. So the correct version of the sentence is a decrease in reserve requirements increases the money multiplier and increases the money supply. Question number 9, the quantity theory of money suggests that inflation is caused by too much money chasing too few goods. So the correct answer here is answer A. Question number 10, the major objective of monetary policy being pursued by the Bank of England is to achieve a target rate of inflation, which is the answer A, which is the correct answer in this question. Then in question 11, it asks us, in recent years, the UK and the United States has seen a period of low interest rates. Other things being equal, which of the following combinations represents the most likely outcome of cuts in interest rates? So the correct answer here is the answer D. The demand for consumer credit rises, the exchange rate falls, and the rate of growth of real GDP rises. We are going to discuss this question, of course, further in our tutorial sessions. Then we have question number 12, which states higher interest rates normally reduce the growth of demand in an economy, initially through consumer confidence and the housing market. The policy measure described above is an example of the correct answer here is the answer D, a counter-cyclical monetary policy. Question number 13 states, as the level of interest rate in the economy falls, the demand for money, ceteris paribus, increases. So the correct answer is answer C. Question number 14 states, the Bank of Canada purchases $5 million worth of government securities from an investment dealer with a check drawn on the Bank of Canada. The dealer deposits this check at the Canadian Chartered Bank. The desired reserve ratio of all banks is 25%. Assume all chartered banks are operating with no excess reserves and no cash drain. The Chartered Bank is immediately in a position to expand its loan, and by how much money? So we are going to do some calculations for this questions as well. So we know that there is $5 billion worth of securities that are purchased, and we know that the deposits, so the desired reserve ratio of all banks is 25%. So 25% out of 5 million would go to reserves, and that will be 1.25 million. So the remainder will go towards loans. So the difference between 5 million and 1.25 million dollars, not pounds, is 3.75 million. So the correct answer here is answer C. And our final question is, the purchase of government securities by the Bank of Canada is predicted to, and the correct answer here is answer A, increase loans made by the banks.
Okay, that's it. We hope you have enjoyed our resources. We hope you've learned a lot. Economics for managers, strange times, coronavirus. Hope the world will recover from this. Of course it will. And it's been fun having you. We've enjoyed ourselves and our socially distanced lectures, and it's been great. Thank you so much for having us. We hope you've enjoyed yourself. We hope you've learned a lot. And from myself and Emma, thank you very much. Bye for now.
Bye.
All right.